up, my financial savvy thinkers? Welcome back to another episode of the Do.Different.Better Show, where we break down wealth wisdom and money moves to keep you informed and empowered and in control of your financial future. I'm your host, Elaine Rasmussen, founder and CEO of Social Impact Now, investment and social finance advisor and CEO, and your guide to navigating the financial roller coaster of life. And today we're diving deep into a topic that can shake up your money like few things can. It's the D word. That's divorce. Now, that money and relationships are already a tricky combo, but when you throw in divorce and suddenly you're dealing with asset division, alimony, child support, retirement impacts, and the emotional and financial toll of splitting up. If you're not careful, divorce can wipe out years of financial progress. So here's a fun fact, maybe not so fun. Did you know that divorce rates tend to spike during economic downturns? Yes. When financial stress rises, so do separations. In fact, during the 2008 recession, the divorce rate jumped 30% in some states. And after COVID, we saw another wave of couples calling it quits. So today is an unfortunate topic, but once again, I'm your financial BFF. We're going to break it all down. Why is divorce so financially draining? How economic downturns can make divorces more common? Who suffers the most financially post-divorce? And of course, what you can do right now to protect yourself, whether you're single, married, or considering a split. So go grab your coffee or matcha tea, get comfortable, and let's get into it. All right, let's first start with some cold, hard numbers. Divorce isn't just emotionally exhausting, it's expensive. The average divorce in the United States costs between $15,000 and $30,000 per spouse. And that's just the legal fees. The number can jump way up depending on your assets, whether you have kids or how messy the split is. Here's where your money goes in a divorce. First, legal fees. Attorney fees can range from $250 an hour to $600 an hour and more, depending on your situation. If you and your ex cannot agree on anything, those fees add up fast. Asset division, splitting up property, bank accounts, retirement funds, and even businesses takes time. And you guessed it, money. Alimony and child support. If one spouse earns significantly more than the other, they may be required to provide financial support for years. Housing costs. One of you is most likely moving out, meaning doubling rent, mortgage payments, and furniture expenses and utilities. Now let's talk about the financial fallout. Studies show that after divorce, women's household income drops nearly 30%, while men's tends to decrease only by 10. Divorcees have less saved for retirement, with many withdrawing funds early to cover living expenses. Credit scores can also take a major hit if joint debts aren't managed properly during the split. So, here's a takeaway. Divorce isn't just about legal fees. It's about restructuring your entire financial life. And this brings me to a bigger picture. How does the economy impact divorce rates? So you've probably heard the phrase, financial stress is the number one cause of divorce. Well, the numbers don't lie. Historically, during the times of economic uncertainty, divorce rates tend to rise. Let's look at a few examples. So in the 2008 financial crisis, divorce rates spiked after the housing market crash as families struggled with foreclosure, unemployment, and financial instability. I was no different. I was a victim of this myself. Many couples delayed divorce because they couldn't afford to separate, leading to a surge in filings once the economy recovered. And I will just tell you, I was in a relationship with a long-term relationship with somebody, and I stayed in the relationship longer because I financially could not afford to leave this person. I could not financially afford to be on my own. We had multiple properties that were vacant. And so I knew that if I left, there would be no way that I could financially sustain myself, much less keep these properties. Next, COVID-19 pandemic. More time at home plus financial stress plus job losses is a recipe for disaster. In some states, divorce rates shot up 30 to 40% post-pandemic. Then there's rising inflation and cost of living. As prices go up, household budgets shrink, causing more money fights, and when financial stress peaks, relationships often crumble. But there is also a flip side. In some cases, economic downturns actually delay divorce because couples can't afford the legal fees or moving into separate households, like I just shared with you in my example. But here's my hot take. The economy doesn't just influence divorce. It changes the kinds of divorces that we see. When times are tough, more people choose mediation over litigation. They split their assets creatively. I have a friend of mine, they are in the process of getting divorced. They have another apartment, but they have a child. So what they do is they share the other apartment when the other person isn't in it. So if somebody, let's just say, for example, is with the child for 1 week, and then the next person is with the child for the next week, the parent who is on the off week lives in the other apartment, which happens to be just down the road from the apartment that they live in, or down the road from the house that they live in. So really making it really creative. They even decide to stay in a financial marriage just to survive. Maybe they date, maybe they have some parameters or rules about other people, seeing other people, but they are staying together financially for either a specific amount of time or until a specific event, meaning, hey, when we pay off this house or we pay off this debt or we pay off this whatever, then we will go through the process of actually finally officially separating or divorcing. So, but here's a question for you. Have you ever noticed more divorces in your network during economic downturns? If so, you're not imagining it. So now let's shift gears to an even more important question. Who suffers the most financially post-divorce? So we know that divorce is expensive, but not everyone feels the impact equally. So I'm going to break this down for you. First, let's talk about women in divorce. Women household income drops 3 times more than men's after a divorce. Part of that is because they're already making less dollar for dollar than a man in the first place, right? I think the average now is up to, I think it's 82. For every dollar a man makes, women are making 82 cents for the same job in the same industry. 40% of women fall into poverty after divorce, especially if they've left the workforce to raise kids. They don't have experience and they're going back into the job market after a long period of time. They may not have skills, they may not have knowledge, they may not have acuity on how to manage the new kinds of technology systems that companies may have had they been still in the workplace. And so they really have to prove themselves and work harder to get that same job, to prove that they have, if not the capability, the aptitude to be able to adapt to the new corporate or office operating systems. Women tend to keep the family home, which sounds great, but it often becomes a financial burden due to mortgage costs, taxes, and upkeep. Now let's talk about men and divorce. Men typically see a smaller drop in income, but higher financial obligations such as child support or alimony. Many divorced men delay retirement because they lose a significant chunk of their assets in a split, particularly if somebody has gone through multiple divorces. And so they've had to go through this process multiple times. Their financial nest egg has been continued to be crippled, right? There is a limitation on that because as they move into the second marriage, whatever they have would be considered a premarital asset. And they would not have to share that, but anything that's built with that spouse during the marriage, that is definitely up for consideration and disposed of based on your state's particular laws. And we'll talk a little bit more about that in just a moment. Divorce often leads to a lower credit score due to unpaid joint debts. Let's say I've known and I've been experienced this myself of you're with a partner, They are not good with money. They've run up a lot of debt. That becomes your debt when you decide to separate or divorce. Retirement savings can also take a hit because funds get split or used to pay legal fees, or worse yet, they're paid, the taxes are deducted, and that could be up to 40% because you need to take that out to split it. Now, once you pay those taxes, you can then roll it over into a Roth IRA, and then you don't have to worry about paying those taxes when you decide to retire. But it's a short-term pain for a long-term gain. Building wealth after divorce is harder because there's often less discretionary income. So here's a big takeaway. Divorce is financially devastating for both parties, both in the long term and particularly how it affects women is definitely significantly harder than how it hits men for all of the traditional gender role reasons, right? But we're seeing a little bit of a trend where as over the last, I'd say, decade, we're seeing a lot more men stay at home with children. We might see a reverse on that trend. So it'll be interesting to see, particularly as we come out of this particular economic situation that we're in right now. It'll be interesting to see how that plays out in like the next 5 to 7 years of whether it be in income levels or people re-entering the market, what's really happening. But let's get back to the business we're here for. If you're thinking about divorce, or even if you're happily married, start tracking your finances now. You need to know your assets, your combined assets, and your individual assets and your debts. What are your financial obligations and what are your financial obligations as a couple? What are your long-term wealth building plan? And what's the wealth building plan that you have as a couple? Because whether you stay together or you split, knowledge is power, right? I don't know, my guilty pleasure is watching The Housewives, and it pains me that in 2025, I'm looking at these very smart, very beautiful, very intelligent women. And as they're getting a divorce, they're saying they have no idea what is happening with their financial situation. They're finding out, one of the ladies on, I think it was Housewives of Potomac, is now finding out that there were things in her name that she had no idea. You've got to know everything that's going on with your financial future. If you're not necessarily prepared to find out or have a conversation with your spouse, go pull your credit report. It more than likely will have all of the things that are listed in your name, especially if there's been any sort of debt connected to it, right? It will be reported on your credit. That's one good way to kind of know if something's been put in your name and you don't know about it. So then you can go to your partner and say, hey, can you tell me a little bit about this? Is this an investment that we made? What's going on with this? What are the obligations of this particular, what's the term of this particular obligation? What are the circumstances? Do we have an exit strategy in case this doesn't work out? How much is this costing every month? How much is it costing every year? Are there taxes that we have to pay on this? What are the other obligations related to this particular financial obligation, whether it's an investment or not, right? But you should definitely, I would encourage you to not let fear take over. Do not let fear put you in a position where you then become a victim of your own lack of curiosity, right? You've got to sit down with your partner, and maybe it's something you do. I always like, talking about money is never easy. We all have our stuff that we bring to conversations of money. So maybe you want to think thoughtfully about how you want to have that conversation. Maybe you tell your partner in advance, hey, this weekend, I'd like to set up an hour with you to talk about this. I know that that's something I do with my partner. They do a lot better when I tell them in advance that we're going to have this conversation because they have a lot of angst around money conversations. So by giving them advance notice, it gives them an opportunity to settle, get comfortable with whatever might come up in the conversation, and then they can have a better, more calm conversation with me about whatever it is that we need to talk about. So be sensitive to what your partner may need, but also be sensitive to what's important to you, what's the information that you need to know so that you feel safe and secure about what's happening in your financial future individually, but also as a couple, right? So I really want you to think about this. And speaking of power, in the next segment, we're really going to dive into how assets are divided, how to protect your retirement, and what happens to your debt in a divorce. So stick with me. This is information you cannot afford to miss. If you found this segment helpful, share it with somebody who needs to hear it. And don't forget to subscribe, leave a comment, tell me what you think of the show, because financial literacy is everything. I'll see you after the break when I show you how to do different better. What's up, my financial savvy friends? Welcome back to the Do Different Better Show. I'm your host, Elaine Rasmussen, where we keep it real about money, power, and building wealth that lasts. And if you're just joining us, we're diving into the financial side of divorce, the breakups that hit your bank account just as hard as they hit your heart. In our last segment, we unpacked the cost of divorce, how economic downturns influence divorce rates, and who gets hit the hardest financially. Spoiler alert, it's usually women. But today, we're going to get tactical. This segment is all about how to protect your assets and how financial settlements actually work. Because the last thing you want is to wake up post-divorce wondering, where did all my money go? So here's what we're going to be covering. Who gets what? Understanding the asset division process. Debt after divorce, who's responsible for what, retirement accounts, real estate and investments, how to safeguard your financial future. So, whether you're thinking about divorce, you're going through it, or just here for the financial tea, let's get into it. First, we're going to start off by understanding asset division and divorce. Okay, let's start with a big question. Who gets what in a divorce? Here's the deal. How assets are split really depends on your state's laws, but there are two main legal approaches to dividing property. The first is community property, and there are 9 states that practice community property. That means everything acquired during the marriage is split 50-50 no matter what. It doesn't matter who made more money or who paid for what. If you got it while married, it's considered joint property or joint community property. Examples of states who do this are California, Texas, Arizona, and Nevada. Okay. Second is equitable distribution states. That's 41 states. Assets are divided fairly, but not necessarily equally. Judges look at factors like income, length of the marriage, contributions to the household, and even future earning potential. This means one spouse could walk away with significantly more assets than the other. So here's a key takeaway. Just because you work for it doesn't mean you keep it. Understanding your state's divorce laws before you file is critical for protecting your financial future. Now, let's talk about what actually gets divided. What happens to your property and your investments? So now we know how states split assets. Let's get into the nitty-gritty. What's actually on the chopping block? So first, let's talk about the family home. If one spouse wants to keep the home, they often have to buy out the other's share. Most couples sell the home and split the proceeds, but you don't have to do that. Here's a pro tip. Keeping the house sounds great, but it could be a financial trap if you can't afford the mortgage, the taxes, the upkeep by yourself. So we'll think about this. If you are a stay-at-home parent and you've been out of the workplace for 10 years, and now you're going to go back into the workforce, you have to really think about, can I get a job or make revenue or make income that's going to be on par with being able to maintain this home, particularly if your partner had maybe a 7-figure job and they were paying all of those bills. So it might make more sense either one for that spouse to buy you out, or once again, sell the property and you just split the expenses. You split the profit down the middle or according to your state's parameters, right? Now let's talk about retirement accounts. Many people don't realize that retirement funds earned during the marriage are also joint property. even if only one spouse contributed. Qualified domestic relations orders, or QDROs, are often used to legally split these accounts without tax penalties. But also, here's a pro tip. You can also roll over your share into an IRA instead of cashing out, which protects your future wealth, right? And usually rollovers are free. They don't charge you to roll over your account because they're looking at the money that they're going to make on holding that capital for you. So there's usually no charge to roll over your IRA from any kind of incident where a financial benefit event, right? So whether that be an inheritance, whether that be at proceeds from a divorce, if you roll those over, typically financial institutions will do that rollover for you for free. It's just some paperwork you have to complete. Now let's talk about business ownership. If you own a business, a divorce could mean your ex gets a stake in it or forces a buyout, right? Meaning you have to buy them out based on the value of the company. Prenups and operating agreements can protect against this. So let's talk about, prenups, prenuptial agreement. That is an agreement you have with your partner before you get married that outlines if we were to ever separate, divorce, these are the terms, especially if that person has had a spouse prior. I highly encourage you to have a prenup, because by going through the process of a prenup, you will find out if there are implications from your partner's previous divorce that could impact your financial future. And that is something, by having a prenup, could create the circumstances by which you have this conversation with your partner, and legally do the things that must be done to protect your assets, particularly your personal assets, but definitely the assets you and your partner have throughout the marriage. The thing about operating agreements, you can put in the operating agreements that this particular business is solely owned by you, particularly if it was before the marriage, and this particular, that you both agree that this business will not be a part of any divorce settlement. That is something you can agree to in advance. Or if you want to say, hey, this person only owns 25% and I own 75%, whatever the circumstances are, having an operating agreement that outlines the ownership model of the particular business that you are running, so that in the event of a divorce, and I never wish this on anybody, but in the event of a divorce, that is treated differently than the rest of your familial assets, right? But if you don't have one, if you don't have an operating agreement, a business valuation is often required to determine objectively what is the business worth. So then you can come up with some kind of operating agreement that says, this is the value of the company, this is the percentage of ownership. And so each part of that ownership equates to a certain dollar amount that which you are entitled to and you can hold on to, or you can be bought out if this person no longer wants you to be a part of the business. Then there are stocks and investments. So stocks and investments that are acquired during the marriage are subject also to division. And so here's another pro tip. If you're in a high growth company, negotiate to keep your stock in exchange for other assets, right? You can ask for that. So here's a key takeaway. Everything is negotiable. Just because an asset is considered maritable property doesn't mean it has to be split 50-50. You can have strategic negotiations that can make a huge difference in what you walk away with. But also, there is some hidden dangers on who gets stuck with debt. I can't tell you how many people, mostly women, that I know that have gone through divorce and have been strapped with their partners enormous, gut-wrenching, throat-choking debt. This really doesn't get a whole lot of attention when we talk about divorce and when we talk about financial management, but it has such significant financial damage, and that is debt. This is how debt is divided. Joint debt, such as credit cards, loans, mortgages, if your name is on it, you are responsible for it, even if your ex agreed to pay for it in the divorce. First of all, if that's what they do, you want to get that in writing. You want to make sure it's notarized. You want to make sure it's not on the back of a napkin. It is written out that they are assuming the responsibility. That is just the agreement between you two. That has nothing to do with the credit card company. You can present that to the credit card company, but they're probably going to tell you you're still liable for half. But if you were to pursue legal ramifications or legal options regarding that debt, having that piece of paper could help you in a circumstances to make you not liable or less liable for that debt. If your ex stops making payment, your credit score is going to take a hit. So that's another reason why either you just want the debt put in their name, meaning they assume the credit card, you get your name off the credit card, or you just decide to pay it off with the proceeds of the sale of an investment, whether it be a house or stocks or investments for your retirement plan. Individual debt. If the debt is only in one spouse's name, they are generally responsible for it. There are some exceptions, like in the community property states. Even individual debts can be split between the partners. So once again, here's a pro tip: protect your credit. Remove your name from joint accounts before the divorce is finalized. Freeze joint credit cards immediately. If your ex is responsible for a debt, have the lender legally transfer it into their name only. That may not always be as easy as it seems, because sometimes what the financial institution will require is that person to go through the underwriting process again on their own, so that they can make sure that this person can manage the whatever the payments are for that particular piece of debt. If they are not able to qualify, then the financial institution might reject them as being the sole borrower on the debt, and which means, once again, you are both responsible for that debt unless there's a judgment or an order by a judge in a court. But let's be real, just because the court says that you have to pay doesn't mean that they will. So once again, this is why you just want to do everything on the up and up and take care of things. Leave no stone unturned and leave nothing unsaid. So before we wrap up with this segment, let's go over the actionable steps that you should take to protect your finances in a divorce. So first, get organized. Gather all financial documents, bank statements, tax returns, investment accounts, credit reports, and any legal documents. Many of these can be obtained electronically, but typically they're mailing you these statements, and you or your partner may have them in a file. Gather them together, make a copy so that you have a copy as well as your partner has a copy, and that are separate. In case the other person decides to destroy these copies, you have your own copy. 2, consider opening separate accounts. If you don't already have a bank account in your name, open one now and direct your income there. That way is another layer of protection where your bank accounts are separate. 2, know your numbers. Understand your total assets, liabilities, and income streams. This helps prevent getting shortchanged in a divorce. Now, when you're going through divorce, especially if you're a higher net worth person, there's usually going to be, you can request or you can hire a forensic accountant. This is when you see in the movie somebody who like goes and tracks all the money and all of the Swiss bank accounts and over bank accounts overseas and in Jamaica and the Bahamas. Those, once again, are expensive. They are expensive. But it might be worth your while, particularly if you're a high net worth person, to go and find that money, especially if you have been a stay-at-home parent. You're going to need those financial resources to be able to get yourself up back on your feet. The other thing that you can do is consult a financial planner. A divorce attorney is great, but a certified divorce financial analyst, a CDFA, can help optimize your financial settlement. Once again, particularly for folks that are high net worth folks, if you have a household income over $500,000, this might be something you might want to consider, right? And then avoid emotional decisions. Don't hold on to assets just because make sure they align with your financial future so that you don't get burdened with something that you really can't afford to keep on, or you don't have the emotional energy to keep on. So here's my final thought. Divorce isn't just about separating from a partner. It's about securing your financial independence. The better prepared you are, the stronger your financial future will be. So here's my call to action to you. Take 10 minutes today to review your financial situation. Whether you're single, or married, or in the middle of a divorce, the best way to protect your wealth is to know exactly where you stand. So now, in the next segment, we're getting into post-divorce financial planning, how to rebuild, grow wealth, and set yourself up for long-term success. Trust me, you're not going to want to miss it. If this episode is hitting home, share it with a friend who needs to hear it. And don't forget to subscribe because financial literacy is everything. I can't wait to see you back after the break when I show you how to do different better. What's up, my resilient money makers? Welcome back to the Do.Different.Better Show. I'm your host, Elaine Rasmussen. Here's where we turn life's curveballs into wealth building opportunities. We've covered a lot today in our episode and covering the cost of divorce, protecting your assets, and handling financial settlements. But now it's time for a fresh start. Because whether your divorce left you with a stack of legal bills or a newfound sense of freedom, this is where you take back control of your financial future. So, and then in this final segment of the show, we're going to be getting into how to recover financially after divorce, budgeting, credit repair, and handling new expenses. We're going to be talking about building new income streams from career shifts to side hustles. Also creating long-term wealth, because divorce is not the end of your financial journey. It's the beginning of a new chapter. So grab a notepad, grab your iPad, whatever tool you're using, because I'm going to be dropping real life actionable strategies that will help you bounce back stronger than ever. So let's go ahead and get started. Let's start with the foundation. And that is resetting your financial game plan. Divorce is a financial reset, whether you were ready for it or not, you've been planning it or not. That means new income and new expenses and a new way of handling money. For just by the very nature, you won't have your partner anymore. But first up, let's create your post-divorce budget. Here's what changes after a split. You're now managing expenses on one income instead of two. There may be new child support or alimony payments receiving or paying. There are some housing costs, utilities, and insurance premiums that might be higher because of where you're living or other circumstances. Now, if you haven't already, switch to a zero-based budget, which means every dollar you earn has a job, whether it's rent, bills, savings, or investments. Next, you want to build your emergency fund. If divorce drained your savings, rebuild an emergency fund ASAP that aims to last 3 to 6 months of your living expenses, right? Once again, start small. $25 a week adds up over a long period of time. Use windfalls like tax refunds or bonuses, or even selling old belongings to give you your savings a boost. Cutting costs where you can is what's next. If you're still paying for joint memberships, streaming services, or even your ex phone bill, cancel it now. There are some great apps like Rocket Money that can help you find all of those unforeseen, recurring subscription costs. Refinance high interest debt if possible, especially credit cards or personal loans you took out during the divorce, or move them over to credit card that is just in your name, but have a plan to pay them off as soon as possible. That is valuable money that you could be investing. I also want you to look at cost-effective living arrangements. Downsizing just for a little while might free up some cash. Taking on a short-term rental or roommate, but these are all things that you can do in a relatively short period of time that will actually give you a chance to level out. I talk about some of these tactics when building a financial plan around losing a job. These are some of the same tactics. So you can go and listen to that episode where I go into some of these in a lot more detail. But here's what I want you to do. I want you to take 30 minutes this week. Go ahead and take out your phone and put time on the calendar. I'll wait. Then I want you to go through your bank statements and look for places to cut or reallocate money. The sooner you adjust, the faster you would gain control over your financial situation and your financial story. Next step, increasing your income and your career goals. So let's really talk about making money moves, because if divorce forced you into a tighter financial spot, the best way to fix that is to increase your income. Assess your career and salary potential. This is the first thing you can do. If you're employed, now is the time to ask for a raise or promotion, right? Research your salary benchmarks in your industry. If you're underpaid, gather proof of your contributions and use it as a terms of negotiating. There's some great websites out there like salary.com. There's salary calculators where you can put in the city you live in, the job that you're in, the size of the organization, how much years of experience you have, what kind of education you have, and it will spit out for you. This is a recommendation of where your salary should be. And here is where you fit in the range of everybody who has this job currently. So you get to kind of see where are you sitting and where you might have some leverage and some room to be able to go. The other thing that I really encourage people, particularly women, and particularly women of color, is to go pull the financial statement of your current organization, particularly if that organization is a publicly traded company. All of their financial records will be public. If you're working in a private business, it's a little bit more difficult. The owners may not want to share that information. You may not have access to it. But what you can ask is, what did we do in sales last year? What did we do in revenue last year? They usually love to talk about that number. So you can use that as a basis of, if I'm asking for a 10 or 15 or 20% raise, it's because our sales have grown by 20%. And what were the contributions that I made to attribute to that increase in sales revenue, right? That is making the argument or setting up the terms to negotiate getting a pay raise. Now, if you've been out of the workforce, consider some professional development courses. Many of them are free or online. There's Coursera, there's Udemy. If you just go on online and put in free course on whatever, maybe it's a free course on AI education instruction, right? Anything to start bolstering your certifications or your education, your development that makes you more attractive in the job market. But so many of these now are online for free or for low cost, particularly if you know there's a particular certification you need for a particular job that you're looking for. Also, update your resume, your LinkedIn, and really start to network. The next thing to think about are side hustles and passive incomes. I've talked a lot about these in previous episodes. But if you need more income streams, side hustles can be a game changer. Some great posts, divorce side hustles are freelancing, like writing, designing, consulting, selling digital products like ebooks, online courses, renting out a room on your property, investing in dividends and paying and buying stocks. But here's a pro tip. Turn any extra income into a financial cushion. Just don't go out and go and spend it, right? Put your side hustle earnings directly into a savings account, particularly a savings account that you can't easily access. This might be a digital, an online bank where you can't just drive up and go to the ATM. Make sure you refuse the ATM card. They might send you a debit card or an ATM card. Say, I don't want the ATM card, because the whole objective is this is a holding or savings account. Particularly choosing a high yield savings account is best. But you can take these side hustle earnings, put them into investments, or start paying off debt. What's really great about the Betterment app that I love is that if you wanted to save for purchasing your next investment property or investing in a REIT, you can actually set that up as a goal and you can divert money into that from your bank account. Once again, this is all post-tax money because this is money that's come from revenue that you've earned, unless it's a side hustle. If you have a side hustle and you are not paying taxes on that, you may want to put away money to pay the taxes for the next year, because those taxes will come due. Uncle Sam always wants their cut, all right? So here's an action step. Research one new income stream this week, whether it's freelancing or consulting or launching a small digital business. Even with an extra $500 of income, it could really add up quickly, right? So you think about that $6,000 extra dollars a month if that becomes a steady stream of income. And that $6,000 a month over 2 years could be the down payment on a very small property, right? But if you're able to double it because you've invested it in the market, maybe after 18 months, you're actually able to have 20% down payment for your next investment property, or take that $12,000 and you can invest it into a real estate investment fund. So step 3, investing for long-term wealth. Now, let's talk about long-term wealth, because I don't want you to survive post-divorce. I want you to thrive. So what I need you to do is start to reassess your investments and retirement plan. If you had joint retirement accounts, make sure your share is rolled into your own singular individual IRA or 401k. Increase retirement contributions to make up for lost time if possible. If you've received alimony or a lump sum settlement, invest a portion of it. Don't just let it sit in a checking account losing value. Checking accounts right now in the moment are paying nothing. So you want to put it into something that's paying you something. This is where you get to invest for growth. If you've never invested before, now is the time to start, even once again with a small amount. There's lots, like Acorn allows you to invest with, I think it's as little as $5. Betterment, once again, you can set it up and have it directly go from your paycheck into your Betterment account if you're saving for an incident or you want them to start investing for you. There are fees associated with that, but you would have fees with any advisor. You can go check out my show on the wealth advisors and how much they charge and what is the structure of that looks like. Start with index funds or ETFs or dividends paying stocks. They're great for long-term growth. Next, think about real estate. Consider house hacking, REITs, which are real estate investment trusts, or rental properties if you're looking to build passive income streams. Next, you can think about updating your estate plan and insurance change beneficiaries on your life insurance policies, retirement accounts, and wills. I cannot tell you how many times I've been told by somebody, like years after they've had a divorce, they're like, I didn't realize my ex-wife was still a beneficiary on my insurance or my retirement or my Social Security. So definitely after you've gotten a divorce, and once again, you don't have to do all of this all on day one after your divorce is finalized. But once again, I would recommend the year after your divorce is final, or maybe you want to start a little bit earlier, depending on how much you have going on in your life, but you set it up as a year. These are the 12 things that I want to accomplish. I want to make sure I review all of my insurance policies. I want to make sure I set up my own IRA. I want to make sure, right? Those are all things. And so you tackle one thing a month, right? And at the end of the year, you will have gotten everything done on your 12-point checklist, right? But think about this. If you received a home or assets, make sure they're properly insured. Create or update your will to reflect your new financial reality. And so here is my final thought for you. Divorce is a financial reset, but that doesn't mean you have to start from zero. With some smart investing and long-term planning, you can turn this into a power move for your wealth. So, that was a lot, right? And I know that wasn't just like the greatest topic, but I cannot tell you, I'm seeing this a lot, and it's really became a topic for me as I was watching several episodes of The Housewives across all of the franchise of women going through divorce, and literally these women having no idea, and some of the married women saying, I don't know what's going on in our financial life with my spouse. And I just, I was thinking, I'm like, how are we in 2025 as women still being vacant from the financial conversation with our partners? And so this really just hit my spirit that I needed to do this episode to talk about not just women, but just really understanding what happens to you financially in divorce, because I don't think that anybody talks about it. No one talked about it with me. I can tell you, I don't have any of my friends who even talked about it with their kids to talk about what is the implications of a divorce. Not to say that you shouldn't do it or you should have a divorce, but I think whatever the situation is, you should know what you're getting into, right? So already my financial fierce people, that's it for today's episode, but let me do a quick recap for you. 1, as you're going through the divorce or as you're coming out on the other side, reset your budget and cut unnecessary expenses until you find your financial footing. 2, find ways to increase your income, whether that's through a raise, side hustles, or a career shift. 3, start investing for long-term wealth because your future is in your hands. And finally, here's your action plan for the week. I want you to review your budget and start an emergency fund if you don't already have one. I want you to explore at least one new income stream. And if you haven't started investing yet, open a brokerage account and start with $100. Here's my final reminder. Divorce is a chapter. It is not a whole book. You can come back financially stronger and emotionally and mentally fit. If this episode resonated for you, please share it with a friend, leave a review, and subscribe. Hit the subscribe button because financial empowerment is for everyone. So let's build wealth together and do different better. Don't forget to hit the subscribe button. Visit me on my YouTube channel, Do.Different.Better, and let me know how this show has helped you think about divorce and reimagining your financial future post-divorce. Thank you, and I will see you next time. I'm your host, Elaine Rasmussen.